Hey, what's up, guys? Hope you all are doing good. I'm doing well. In this video, we will talk about credit spreads. What are credit spreads? How you can execute them. I'll show you an example of how I am gonna execute credit spread for you. And then I will also give you some other examples of different shares and ETFs that you can play with to have the better probability of having profitable trades. And then I will also show you one YouTube channel that I think you should subscribe if you are interested in making money using credit spreads. And lastly, I will tell you the reason why I consistently don't use credit spreads. So this video is jam-packed. If you're really interested into learning all this, make sure to subscribe and like this video, and let's jump right into this video. So first thing first, today, as you can see, my portfolio is up 1.8%. That is $3,350. Currently on for the year, we are up 1.1%, and that is better than S&P 500, which is up only 0.48%. So that's good. We are beating the market. Basically, we are actually beating QQQ as well. So QQQ or Q's Nasdaq 100 is up only 0.25 for year to date, while we are up 1.1%, as I just told you guys. So that's just the overview of this portfolio, and I make other videos if you are interested into more details of my portfolio, ETFs and stocks that I hold, and what are other strategies. Make sure to subscribe to this channel. Moving on to talk about credit spreads. So credit spread is a little bit of aggressive strategy compared to selling cash secured puts and covered calls. And why I say that is you will see in a minute, but it's a strategy where you think that the stock or the ETF value will not go really high, so that it is out of the money, the option expires out of the money, and you get to keep the premium. And I'll show you guys example so you can understand it better. And for this example, we'll take SPY ETF, which is S&P 500 index ETF. Currently, I have invested over $50,000 of my portfolio worth, and I am up close to $2,600 on this investment. In order to create credit spread on SPY, you need to come here on the right side. Make sure that your trade options is open. This is the level 3 of trading in Robinhood, and I can make a separate video how you can enable options trading in Robinhood if that's what you really want to learn about. Going back to credit spread, how it works technically is basically you sell a call and then you buy a call out of the money. So say for example, right now the current price of SPY is $593.03. So going out a couple days, I would say that in couple days I'll be selling call at around $40 credit, and then I will buy this call with a $28 or $29 worth of another option. So basically, I'm selling a call at $600 and then buying a call at $601. So if you see here, when you select these numbers, you'll see here call credit spread, and this will be the ratio, basically one-on-one ratio. And you see you will be credited 11 cents or $11 per contract. And maximum loss you see here is $88, and maximum gain is $12. So if I continue here and I select the mid price, which is already selected, 12, and then say for example, if I were to execute 10 contracts of these, meaning investing $1,000, I will be able to make $120. That's 12% return on investment in a couple days. That is the beauty of call credit spreads, because the rate of return is really high compared to selling cash secured puts or covered calls for this delta. And how do I select these values? So that's a good question. Like how do I came up with 600 and $601 value? So one thing I do is I make sure that ETF, especially if it's an index ETF, SPY or QQQ, had a green day before. So meaning yesterday it went up almost 1.86, almost 2% here. So in that case, there is less probability that SPY or QQQ keep going with the same pace, meaning gaining again 2%, 2 consecutive days. And that is what I want to play the options with. And then for the delta value, delta again is the Greek, one of the Greeks that option is trading. If you have done any options trading before, you probably know what are all these Greeks. But I keep delta here as one of the key factor or indicator deciding what options I need to trade. So why I selected the price 600 when the current price is at $593 is because it is closer to 0.15 delta. On the index ETF, especially for SPY, I select a value which is closer to 0.15 delta. On QQQ, I go little conservative and I select value to sell a call at around 0.10 delta. These are little secure numbers, but again, it tells you that 87% chance that the ETF price in 2 days will not get to $600, and that is why I'm selling this with the 88% probability, 87% probability that I'll be able to make this money without having to deal with any of the issues. So if you see here, what I was showing you is uh, for a maximum loss of $880, I'm making $120. Basically, you put down $1,000 and then you make $120. So in Robinhood, it shows you a loss of 880s. That's the simple math that it shows you. And another good thing that I like about Robinhood user interface here is that it clearly shows you as a beginner investor or trader, you would want to see what are your profit and loss graph looks like, and these graphs are shown for each of the trade that you make. So expected profit and loss, so it shows you if the price of this ETF SPY goes down, you will get to keep the minimum credit that it is gonna give you, which is $110. What just happened? I think it updated because this is let's go back. Sell a call and here and buy a call here and then here and then 10 contracts with 0.12 per contract. So it gives you a view where you can clearly see if the price of this ETF stays below $600, you get to keep 100% of this credit that you see here. So $120 will be pocketed to your bank account right away, and you will also get your money or $900 back. And in case of or $880, because the maximum profit in this case will be with $120. So it's not showing correctly for some reason, but you get the idea. But if the price of ETF went past your buying power, where you buy the call at, or the price where you buy the call at, the difference, which is $1 in this case per contract, so $100 per contract. um, if you see that, if you pass that, then you will start losing money. Basically, you will straight up will be losing $880 and right out the gate if it passes your buying call leg that you have here. So that is why it is bit risky. And as I said, that I'll tell you guys the reason why I don't regularly trade these options, these credit spreads, is because of this sole reason. Because I'm not comfortable trading my $1,000 just to make $120. That comes with ifs and buts. If the price goes up, then I'll lose all that. Of course, there are options to roll these contracts. But again, like I don't want to keep rolling these contracts. If I get assigned in cash secured puts, I take that and I start selling covered calls, and that's what my main strategy is. But that's another way that you can avoid by rolling these options. Talking about rolling options, as I initially talked about, like I'll show you guys this channel, this YouTube channel. So this is the YouTube channel that I was talking about. It's called Credit Spread Investing. And this channel basically shows you how you can make losing trade into a positive trade for yourself. If you're losing money, you can roll these credit spreads as well. If you are interested in this because the rate of return is really high, return on investment for you, you can definitely do that. But I've tried this when I initially started trading 4 or 5 years back, and I lost a good amount of money at that time, $2,500, $2,600, just in this. And that is when I started trading cash secured puts and covered calls, which is my core strategy to build passive income with this portfolio. So that's about it. Thank you guys for watching. I hope you guys like this video. If it helped you understand some concept, make sure to leave me a comment and provide your input. I'll really appreciate that. And I'll see you guys in my next video. Till then, take care of yourself and people around you. Goodbye.